We are operating under the assumption that a bear market in bonds has begun. So that's how we think about it going forward. Imagine the next 5 years and how strikingly different they are from the last 5 years. So next 5 years, because of quantitative tightening and the Fed's balance sheet unwind, they are going to unleash $1 trillion of supply that wasn't there before. So even though the Treasury is going to, even though the Fed is going to just let maturing securities run off, what that practically means is the Treasury has to issue refunding bonds, because they're not just paying down principal, they're just replacing the ownership of treasuries from the Fed to the private sector. So the private sector over the next 4 years will have to purchase $1 trillion of debt that is maturing off the Fed's balance sheet. On top of that, they will have to fund the US budget deficit. So whereas earlier the investor focus was on the size of the Fed's balance sheet, we think going forward, the investor focus will be on the size of the US budget deficit, especially as the US government becomes more and more dependent on the bond market. And this is occurring at a time, like I said, with Trump as president, with the replacement of Fed-owned treasury debt, we're seeing at least $2 trillion, if not more, of supply coming onto the market. On the demand side, central banks are stepping back. We know foreigners have been selling for the last 2 years. And frankly, again, with Trump as president, who has said publicly that given the size of the US debt, if it came to it, he would restructure or default. So that doesn't really inspire confidence on the part of global investors to frankly own US treasuries. So it's not likely that we're going to see a significant increase in foreign ownership of US treasuries, especially as it is already concentrated. And over the last few years, we've seen money moving into fixed income as opposed to equities. So whereas QE and central banks created a shortage in safe assets and a squeeze on fixed income that resulted in record low yields, the next 5 years are probably more likely to see a supply-demand disruption occurring, which will lead to significant market turmoil. I would argue that we could see in the next crisis, whenever it occurs, bonds as a source of financial market volatility. So 2000 was the peak of the tech bubble, 2006 was the peak of the housing bubble, 2011 was the peak of the commodity bubble. We are operating under the assumption that 2016 summer was the peak of the fixed income bubble. And if that is the case, then in the next financial crisis, whenever it occurs, we think, given bonds will be the source of financial market volatility, the portfolio diversifier effect of treasuries will no longer function. So risk parity will get killed, because bonds will sell off, stocks will sell off, everything will sell off. So I just don't see a very strong merit to own fixed income securities at this point in time.